Let's continue with the topic on the Supreme Court ruling on the sweeping tariffs. I said that I have 7 points. Let's continue. The last time I said that, one of the most important points is that you should not take that trade deficit as a sign of a strength or weakness, or as winners or losers. That's not the way it is. One of the important reasons is that you have to think about this. When let's go back to look at the big picture. It's called something called the balance of payment, BOP. And then there's a two sides of it. One side is that the accounting identity basically says that if you add current account and capital account and financial account, more strictly speaking, you need another one called statistical differentiations, kind of a residual. If you add this up, the total will be zero. It basically means that that accounting identity of balance of payment, it doesn't mean much. It's kind of a boring. It's basically irrelevant. The most important thing is that you see the composition. You see the sustainability of this imbalance. Okay. And then, by the way, so there's one important, one not so important. You have to think about why we have a statistical differentiation, statistical fluctuations. Because for one thing, that tariffs, is an import. The great trade, global trade is basically controlled by customs. Every time you export something, every time something get in, you have to go through the customs for each country, right? But then the financial account balance, that's capital inflow and outflow, that's basically controlled by the bank, including the central bank. So you have to. That's why it's inevitable to come up with some discrepancies. We call it statistical discrepancies, but it's really because it's inevitable because different entities, different government agencies, they are taking the numbers. So you have to reconcile. But the short-term discrepancies, it's almost inevitable. But here, let's bring this important framework into account. What is the balance of payment? It includes three parts. One is the current account. That basically, from you looking at the big picture, says three parts. One is that trade deficit. Basically trade deficit or surplus, right? If you export more, then you can import more. Then you have a surplus. If you, like the U.S., you buy in more from the foreign countries instead of you selling more to the foreign countries, then you have a deficit, right? So that is not really, it's by itself. It's not the entire picture. You have to take the next, there are three parts of the current balance. One is that current account. I'm sorry, CA. One is that the trade, and that is primary income, and then the final one, the secondary income. The primary income, basically, anytime you have like Apple or Coca-Cola, they have overseas, they do that, foreign direct investment, then they have the subsidiaries from the overseas, and then anytime the subsidiary overseas pay them the dividend or income, then that's a primary income, basically associated with the productive capacity overseas. Okay. And then the secondary income is basically, think about the Filipinos. There are a lot of Filipinos because they speak English, right? A lot of Filipinos, they ended up being the nanny in Hong Kong. Then every year they send money home. So remissions, that doesn't involve the production. It's just the money changing hand. Okay. Same thing applies to the government aid. They give the money to some developing countries and then those kind of things. So there's three parts. But if you look at the macroeconomics, they basically the current account is basically equal to two things. One is that domestic savings, and that is investment. So think about this: if you have like some, back in the tech booms back in 1990s, U.S. has a lot of investment into those Apples, into Microsoft, those kind of entities, but they are used to get more production. So basically, you will have an investment. You will have some returns. Obviously you expect that the return is higher than the investment. Otherwise, nobody is going to be willing to invest, right? So that kind of thing. Anytime. So basically, CA equal to domestic savings and minus investment. If your investment is big, but the domestic money, like U.S. Americans, they don't like saving much money, and then you have a deficit. So you have to borrow from either two ways. Either you borrow from the foreigners, right, and or you attract foreign investors to invest in the companies. So either way, it's a good thing if you have a current account deficit because you have a lot of productive investment, even overpower than the domestic savings. That's a good sign. That means that the economy in the long run will grow. Okay, so that kind of a trade deficit. It's going to be a trade deficit, right? Because like I said, I didn't because I should have mentioned that there's three parts of a balance of payment. One is that the current account. The second is a capital account. Basically, you can ignore that. There's very little thing involved. Basically, you're talking about debt forgiveness. It's a tiny part of it. But the next one is important. It's a financial account. So you have the financial account could be anything related to capital inflow, capital outflow. Basically, if you look at the higher level, whether you have more capital flow in, then you more capital. You have something called capital flight, meaning that your capital, your money is flowing out of your country. Okay, so basically here are a few things that to keep in mind. Number one, if your current balance sheet deficit, just for our purpose, just think about the trade deficit, okay? And if you have a current account deficit, but it's because you have associated with the capital inflow, that's healthy. That's good news. That's exactly what happened in the U.S. for years. Okay, U.S. has been since like 1975, 1980. U.S. has been running trade deficit for decades. Meanwhile, more money flow in than money flowing out. Unlike Argentina, right? Countries like Argentina and Venezuela, those countries, they have more capital. So in fact, that capital that we have for developing countries, we have a double deficit. One is a trade deficit, another is a capital inflow deficit. Because meaning that that's a tragedy. That's the worst thing that we can have. That means that if you have a double deficit, that means you can only sell. The central bank will sell the foreign reserves and then get some money. So that's bad news. But in the U.S., in the case of the U.S., it's a very, very beautiful thing because you are trying to get. You are not only trying. In fact, you don't have to try that much. Why? Because people are trusting you. That's why another thing that I want to emphasize is that if you have a capital inflow based on the trust, that's even better. Okay, not based on the U.S. just American dollar is just the U.S. Reserve currency. There's not much better alternative. Then that's a kind of a shaky. But if people, you know, send money into this country because they trust you, and then that would be a good thing. That's the point that I want to make. That the Trump has been doing this country a bad thing because by acting as a dictator, I don't think that he probably don't even understand the difference between taking the like as acting as a company's CEO, because he has been a CEO. He runs this country like a CEO. And then he doesn't understand that, I hope that he understands, but I'm just assuming based on his action, I don't think he really has a deep understanding of running a country versus running a company, right? A company is strictly hierarchy, but a country is really, why? Because country need to have trust, international trust. That's why by the Supreme Court, the people who are criticizing Trump, I'm not particularly criticizing Trump himself, but I'm just saying that what is good for the country. People are doing this country a favor by having criticism, by having Supreme Court ruling. Why? Because we need to let the world know, let every country in the world know that Trump is not everything. We have some way to constrain him, and then that will increase the trust, and that trust is gold to let people give the U.S. more capital, invest more capital. So let's stop here.